It's time for another Monday Morning Roundtable, and I'm joined, as usual, by Jeff Zananiri, Jeff Yasteen, Roger Scott, and Adam Sarhan. Gentlemen, welcome.
Morning.
Hey.
Markets are setting new records every day again. Looks like the incoming administration is being well received by the market. Anticipation of 1.9 trillion that Biden is actively lobbying for. Looks like a fait accompli, as they say in France. What's your take on this, Adam?
Sure. So my take is the bulls are still running. We have a ton of earnings coming up this week. We have economic data such as GDP, and we've got the Fed. So there's still, there's no real catalyst or reason as of right now to sell. That could change with anything that I just mentioned, but until it changes, the bulls are clearly in control. And now we're entering a very, very frothy environment from any historical norm. When you see stocks, like Roger had mentioned earlier, just soar. I mean, you've got so many of these. You've got SPACs, you've got no sales biotechs, you've got a lot of just hot money coming in and just throwing money anywhere and seeing the stocks just shoot up. That's a sign of, wait a minute, we've seen this before. It's not the first time we've seen a hot, very frothy environment. So the market's very extended. I expect the pullback, but until it pulls back, there's no question the bulls are in control.
Right. So basically, we're keeping our eyes peeled for the proverbial blow off top. And do you see that anywhere soon on the horizon, Jeff Yasteen?
Yeah, just going by what, seasonally, the November, mid-October through like March, April period, historically is, the best time to be in the market. So, there's no magic to what I'm saying, but I would guess that if we're going to see some sort of blow off top, and I agree with Adam, I think we're getting to that stage. We're not quite there, but we're getting there. So I'm going to just kind of go out on a limb and say maybe, early March, beginning of March perhaps. But I think for all of us, we'll kind of know when we see it because we're seeing it now, as Adam and everybody else has said. So many of these stocks, and it really doesn't even matter what it is anymore. It could be a mistaken name for a company, like we've seen with Elon Musk, tweeting out the name for something, and then people say, "Oh, it's this stock," and they bid it up 1,000%. It's just that sort of thing. So enjoy it. Just don't get too comfortable. And as Roger has said before, if you've been off to a great start, like all of us have this year so far, then don't spoil it by getting so overeager that you just buy way too much. And when the market does turn, and it will turn, right? But when it does happen, your losses are small, and you can just backtrack for the next move higher.
Sure. All right, Jeff C., you making any plans for a blow off top, or are you full steam ahead in the bull?
You got to play the game that's in front of you. I mean, right now, there are different types of stocks. There's super high test, high beta stocks that are moving on vigilante, like short squeezes, like, that I haven't seen in probably 20 years, 21 years. I haven't seen moves like some of the moves we're happy now. That's extraordinarily abnormal. I would caution our people that watch it over trying to guess which the next one of those stocks is going to be, because that's a fool's game. I'm still trying to play the game I know, looking for stocks that are breaking out in solid industries with good fundamentals and good technicals and good cases. But to try to guess like which the next Ponzi stock is going to be, I think is fool's gold, incredibly dangerous and not a sustainable business plan. And I would warn that it probably could mess you up going forward, because this is a moment in time. This isn't how it's going to be. This isn't how it was for the 22 years that I've been a trader. It was like that for about a year out of the 22 years. So if you develop bad habits in a period, that could last you a lifetime and give you a lifetime full of pain. Trying to find that next sugar high 50% overnighter. It's nice to make 5% on a move in a day. You should be trying to do that. I know it sounds counterintuitive because everyone's just like, who's got the best overnight pop? And, this stock is, trading up 500% in a week on zero earnings, and they have no float. That's a tough game to try to repeat over and over again.
Yeah. Well, Roger, you've had some success recently chasing the hottest, latest, greatest. Tell us about your experience and what attracted you to that asset, and how do we find them again?
To be quite honest with you, we find them all the time. by simply following momentum, because each of these stocks has to go through a certain momentum shift before they become the next rock stars. And if you follow momentum and if you gauge momentum properly, inevitably you will find most of these stocks. So it's not really a question of how, it's a question of how often. Every stock goes from 5 to 10 to 20 to 30 before it gets to 100. It has to go through the process. What we do is to summarize it without going into advanced math or anything like that. What we do is we look at, it's kind of like looking at an Indy 500 race. We look at how fast how fast the stock gains momentum during different similar periods. So I want to see how fast it gained momentum a year ago for a 3-month window. And then I want to compare that 3-month window to how it gained momentum this quarter. And I want to see the momentum shift becoming faster and faster and faster. It's a very different way of analyzing stocks. So we're not just looking at current price action. We're looking at past price action, but not whether it outperformed the current price action, but whether the historic time windows are becoming faster and faster. And that's a very modern way to analyze markets, and something that is available because we have computers to do it. But that type of analysis is becoming, that's very institutional type of analysis, but it allows you to find these stocks rather quickly. It was GameStop, and I think we made about 250, 270% on it on the option, but it was part of our cluster for our small cap billionaire breakout system.
Mm-hmm.
But let me very quickly just answer, go back to the topic at hand, which is really important. We've got the second flow. Last week we had 10% of the S&P earnings come out. This week we have 20% of the S&P earnings. We've got some of the biggest. This week is going to be huge for earnings, as Adam said very, very correctly. We have huge Fed reports, but aside from GDP and aside from the FOMC, again, I'm very cautious about the jobless claims, because if they're going to remain near 900,000, no stimulus, nothing is going to get us out of this mess. It's going to be exactly what we saw last February, March, and April. And in terms of the blow off top, there are several signs that are showing the market is stretched out. Advanced decline line, put to call ratio, percentage of stocks trading above the moving averages, and divergence between the RSI and price action. So the market is pulled. That rubber band is getting stretched out. No doubt.
Yeah. Okay. So then, to what extent would you say that the imminence of a blow-off top is going to be modulated by all of this fresh incoming central bank stimulus? I mean, $1.9 trillion in the imminent term, and we already know that there is more required, as Biden keeps on saying. To what extent is that going to offset the likelihood of a near-term blow-off top? And again, Adam, I'm going to start with you.
Sure. So spot on, by the way, what everyone just said. We've got a ton of other examples as well. The fact is there's two big elephants in the room. There's monetary policy, which is central bank policy, and then there's fiscal policy, which is what government spending. The 1.9 trillion is going to be part of the fiscal stimulus. We've already have the monetary policy going, pedal to the metal. The fact is that there's one thing that we've spoke about just recently on this show is the inflation that could derail, monetary policy. Fiscal side, 1.9 is just the beginning. You have a lot more coming out. And not only that, that's just from the US. Let's look at other developed nations. You've got other countries, major global economies that are literally locked down right now. And those governments are going to have to spend a lot more to help their citizens just get by. That's a ton. It means there's a lot more of a tailwind, so to speak, that's coming. We don't know the magnitude, how much it is. We don't know what the ramifications are. But what we're seeing in real time, like Jeff Z had mentioned, is extremely frothy conditions. And Roger, your point too about all these indicators, the rubber band stretched to the limit. I have a stock that literally a month ago, today's what, the 25th of January, and a month ago in the middle of December, the stock was at 56 cents. It's now at $12. I kid you not. Do they have any earnings? Nope. Do they have any revenue? Let me just check here real fast. They have $2 million in revenue and they lose money. So you get to a situation where people are just throwing caution at the wind. The easy money from central banks has been the primary factor of the entire bull market, I argue, since 2008, 2009. And the second the market goes down, the Fed just puts more money into the equation, and boom, stocks jump again. So just be very, very careful of what your objective is. Are you trading intraday, intra-week, or are you a longer term investor? And then B, ask yourself, where are we in the cycle? Are we early, like March of 2020, for example, when you had a very sharp correction / bear market and then an early V-shaped recovery? Or are we in a situation now where it's a little bit late? Or are we in the middle? You have to make that assessment for yourself and then make sure whatever you choose aligns with your objectives. But as far as I'm concerned, James, to your point, which is fantastic, there really is just an open-ended amount of more money that will be thrusted into the system. And what that happens, nobody knows when the game of musical chairs ends. Just be very, very careful, because when it does, the one thing we all know, it'll be very, very ugly.
You bet. Okay, then Jeff Steam, do you concur with what Adam is saying? And, sort of you got to watch money flowing in as well as keep your eyes out for the signs of a blow off top?
Yeah, of course. And we don't know. I mean, I made my little prediction there earlier. We don't know exactly when, this blow off top is going to happen. But I'll add also, the margin levels. There's just everybody is in all the way at a 45-degree angle with all their cash in the current existing market. Doesn't mean it can't keep going for a while longer here, but when you have stocks as highly priced or overpriced, and so much of like what Adam was saying with these stocks that it may just be a press release, and that's all there is behind the company ultimately. These stocks can just fly. So if you're trying to think ahead for these sorts of things, the best I can say is, number one, know where your exit point is. And secondly, if you're trying to invest for longer periods, it's very hard when you have what we anticipate to be a larger degree of volatility, right? I mean, the market could fall 15%, from here, and we still could be technically in an uptrend. And the thing I've been trying to tell people is think about where value is. And by that, I mean that when a big sell-off comes, it brings everything down. But, the frothiest of stocks is going to fall 40, 50, 60%, whatever, in that sort of scenario, as where stocks where there's real businesses there and real value in terms of what they actually earn, presuming they earn stuff, those stocks may only fall 10 or 15% if you're buying them at the right level, and again, analyzing them properly. So that's the only thing I'd say is you're not going to be able to sidestep it when it comes, but hopefully you can find sort of the higher ground to sort of that the tsunami only washes around your feet instead of carrying your portfolio away.
Okay, very well said. Jeff Z, what's your prognosis on the money flowing in versus the blow off top?
So blow off tops happen when people lose their shit and 20%, 25% a month stops being cool and stops being good or adequate. And so people start forcing returns, and they start looking to manufacture returns almost like an alchemist in stocks that have small floats, that have high short interest, et cetera, et cetera, et cetera. And so when you start seeing those things, and we are seeing those things happen right now, then you're knowing it, you're kind of in the midst of it. Not everything experiences a blow off top. Not every stock goes parabolic and blow off top. It happens in the highest beta, highest growth, riskiest portion of the stock market. I'll say this though, you really have to know what you're doing in terms of, is this an investment bucket of money or is this a trading bucket of money? Because I have trading systems, Roger has trading systems, Adam, Jeff Y, you do, James, that are all different. We run the gamut from swing trading to month, investing for a few months to multi-year investments. And when you become when you play a momentum game, for me, I feel like momentum is the best strategy for swing trading, for intermediate term trading, because you're going with things that could really explode. But if you're chasing momentum as an investor, you can enter a position extremely poorly because they don't ring a bell when it's a blow off top. And then you're going to be stuck with this thing you didn't really care that much about. You were just chasing. You had a little bit of FOMO. So I would lean towards the Jeff Y mentality in terms of finding value if you're looking at longer term time horizons. And with what Roger does and what Adam does for an intermediate mentality, playing the momentum. But to get those things twisted could be incredibly unfortunate. And conversely, to try to force momentum and things in you know, I had an old trading guru boss that ran this big desk at a big bank, and he used to say, I'd rather have a racehorse that you have to rein in than a donkey that you have to kick in the ass to get going. And what I would say is, if you're trying to trade momentum, looking for the donkeys that you have to kick in the ass, you're doing it wrong. But from a longer term investment time horizon, that's probably the way to go.
Right. Okay. So
sorry for all the swearing, but it added to the emphasis of the points.
Yeah, no, that's good. It's refreshing, to say the least. Colorful language, always welcome here. Not exactly a G-rated platform, but
well, that was me. That was me, like translating it from Wall Street Ease, which is much more dirty and horrible type of way of speaking. Maybe people that are out at sea looking for crabs talk the same way.
Well, on the bright side, with that kind of language, Jeff, nobody needs to get a dictionary to see what you mean. So it's all good. The emphasis is appreciated. Okay, so it's interesting to me that in our weekly conversations at the round table, we tend to sort of gravitate from a defensive, conservative deployment of capital based on headline-driven fear, or we have a clear bias. I'm going to say from where I sit, a clear bias towards this idea of momentum trading for shorter term swing trading and finding the imminent breakouts as per Roger's system. So, I mean, shouldn't we just all, have some kind of momentum trading system and some kind of conservative defensive position and just sort of hoist the flag for whatever day it is? Or should it be more nuanced than that? And
have separate accounts, I would say. One thing I say, I have separate accounts for different things, so you don't commingle and you don't get confused as to what you're doing.
So you're talking about a percentage for capital preservation, minor appreciation, and then a high risk bucket that's much smaller, I'm sure.
I segregate everything like that. I even have a separate options trading account. I have an options trading account. I have a stock speculative account, and then I have a longer term investment type of thing.
Oh, interesting. Roger, tell me about your capital allocation account mix. How do you approach that sort of bifurcated momentum versus conservatism versus moonshot opportunities?
I completely agree with Jeff. He's 100% right. It's very difficult to trade multiple strategies in the same account, because remember, your margin, your risk and your margin is looked the same way from the margin clerk's perspective. So you could be if you have an account where you have your retirement account, and you have, I'm just using two extremes, your retirement account where you're holding Ford and General Motors, and then you're selling naked options in that account. Things can get very distorted very, very fast, and messy very, very fast for tax purposes, for margin purposes, for risk purposes, for the way they gauge your account. So the point of the matter is, you want to segregate as much as possible, but you don't want to put all your eggs in one basket in this type of market. Try to separate your account as much as possible. It'll make it a lot easier for your broker and the margin department to make heads or tails of what you're doing, and when not to restrict you.
Mm-hmm. Okay, interesting. Then going into, so here we are, third week of 2021. Momentum is the order of the day across the market. Stimulus is coming. The put is in. What sector is going to benefit most from the massive stimulus? And that's, I'm saying this, throwing out the idea of a blow off top. Let's use our high beta, sort of high risk account and go after some moonshots while all this money is coming in, because that liquidity drives prices higher in the winning categories. So, Adam, I'm going to start with you. Of course, again, what is the top category for you in terms of the beneficiary of more central bank stimulus?
Sure, I would say the big cap tech stocks, the QQQ, the NASDAQ 100 type stocks, just continue to be leaders. Look at them today. Apple's gapping up. I mean, they report earning. A lot of the big tech stocks report this week: Microsoft, Apple, Tesla, etc. So be mindful of that. But stepping back, intermediate and longer term, I think one of the best trades ever in the last 30, 40 years has just been go long big cap tech. And they just work cycle after cycle after cycle. The largest companies in the world are all these big tech stocks. So going forward, if the economy continues as it is, which is no reason why it's not, it's going to be broken down to two areas: the stay-at-home stocks and then the back to normal or back to work stocks. The back to work stocks aren't necessarily the big tech. They're more the airlines, the railroads, the shipping stocks are super cheap or undervalued now. You've got a lot of transportation stocks and so on and so forth, cruise lines, airlines, travel stocks, etc., that have all just been undervalued for a long time. So if we get positive vaccine news, Moderna came out today and said they have a booster shot for this UK variant, whatever the case may be. But if we continue moving towards the back to normal world, and we continue to get a ton of money being thrown into the system, and there's a lot of ends here, and we have low inflation, then you have a situation where you can have a perfect storm, if you will, for higher prices for just everything. Throw the baby out with the bathwater, the whole entire market goes up, and then you get the blow off top. But forget that blow off top scenario. For now, with all the money that's being injected into the system, without all of those ends unfolding, to me, the one area that just continues to shine is big cap tech.
Right. Okay. And Jeff Yasteen, what's your favorite pony in this race?
Yeah, I mean, I think like what Adam was saying, big cap tech is a great place. I mean, it's highly liquid. Everybody's there. You can see the trends very clearly. Another area I like is the vaccine stocks. I think this is a great time to move into some of the secondary vaccine plays. Dynavax, Vaxart, Novavax, because I think with this awareness that is resting on the investment community and the rest of the world, that this thing is. I think I've said for a long time we're in the back half of this. Now I think we're somewhere in the middle. I'm not really sure anymore. But I feel like with that awareness, I think we're going to see continued flows into these secondary vaccine stocks. Everybody kind of abandoned last summer, and a lot of them have started to make sort of secondary highs. They've made their lows already, and I like that. With those, you're buying them at what to me looks like the beginning of a trend higher, rather than buying it high and sort of hoping that it'll continue to move higher beyond an extended level. So you're buying ones that have sort of been left behind already.
Okay, so technology and pandemic related healthcare.
Yeah.
Okay, and then Jeff Z, what's your favorite sort of pony to put money on in the central bank inspired climate?
I'm agreeing with pretty much everything everyone is saying here, but I would add a little bit of a caveat. So I like tech. I like the stay-at-home disruptive trends. I like clean energy. Those trends are going to continue. You just have to. I would say there would be one sector or one aspect of tech that I would shy away from, which is internet, social media type of companies. I'm nervous about going forward. I'm nervous about them being overly regulated. I'm nervous about them having to be split up or reined in, because I think that's going to be probably one of the biggest topics in the world over the coming years, is how these multinational corporations that are not meddling, but they're creating the narrative in certain countries like the United States. You're seeing people start to go crazy in Russia now on the streets, China. I think that there's a risk in some of those. So they tend to get lumped all together. I don't really know why, other than they have websites, but so does everybody. My plumber down the street has a website too. So I would say be a little bit discerning in that and caution. I love companies like PayPal. I think eBay is making a comeback. Netflix had killer earnings, but a little bit nervous about companies like Facebook, et cetera, Twitter. Just my 2 cents. I think you
Okay.
continue to see that. I'm also nervous about the reopening thing because I see that as being a total quagmire. Every day they keep moving the goalposts as to what the end game is for this thing. There's new variants. It doesn't work. You can still transmit the disease with the vaccine. I read over the weekend, which wasn't exactly the most amazing news in the world to read. Probably why you're seeing Carnival cruises down 5% today. But I don't know. I don't know what to make of it. I mean, to predict how the future is going to look, to be a futurist, I think is a little bit difficult in terms of like how we're going to live. I think some of these changes are going to stick. There's a stickiness to it. We'll have to see.
Sure. And Roger, tell me about your favorite sort of sector, where you expect to see the best performance as a result of central bank stimulus, but also what sectors do you think are going to just outperform in the general environment?
Well, I disagree a little bit with everyone here, actually. My view is a little different. Yeah, number one, well, not 100%. Most of what everybody, I agree with what most everything was said here, but here are my little nuances. I think what Jeff Z said in terms of the regulation, I think that's going to impact a lot of other large cap stocks potentially. In a democratic environment, large cap techs are always at a fear of being broken up. So I think we're going to start feeling it, which is part of the reason why FANG stocks have been lagging till now since the first debate of the presidents. That's number one. So I think we're going to see a little lag in the large cap stocks. And remember, even though there's 100 stocks in the NASDAQ 100, the FANG stocks control by market cap about 95% of it. So those 7 stocks are the catalysts in the NASDAQ 100. That's fact number one. Number two, small caps, Russell 2000. Whenever the Russell 2000 lags behind the overall market by over a year, it tends to outperform the large caps by 3 years after. The Russell has underperformed the S&P 500 ever since the trade war started, which is almost 2 years. It has now been leading since the first debate, the presidential debate, and it's still leading. And I believe the Russell 2000 will continue leading, and the stocks in the Russell 2000 will continue leading for the foreseeable future, maybe for the next year, maybe even longer. Number two, Russell 2000 stocks outperform S&P stocks by a factor of 6.25 to 1. Which means for every dollar you put in the Russell 2000 stocks, leading stocks, they tend to outperform the S&P stocks by over 6 times. Number three, a lot of the healthcare stocks, a lot of money's going to be a lot of the Fed money is going to be going into healthcare under Biden administration and solar energy. So small cap stocks. And when I say small cap stocks, I'm not talking about micro stocks. I'm talking about Russell 2000 stocks, which are $2 billion, $4 billion stocks. So they're more mid cap stocks than small cap stocks. So I'm looking at mid to small cap stock, Russell 2000 stocks, and I'm looking at solar power, anything relating to solar, lithium, self-driving cars, those type of things that are all stemming from lithium and disruptive technology. So disruptive tech and the Russell 2000. That's where I'm seeing the strength over the next year or so.
Great. All right, gentlemen, we're going to leave it there for now. That's another roundtable for this week, and I look forward to speaking with each of you individually throughout the future weeks, days rather. Thanks for joining me. We'll see you soon.